Hey everybody, Tom Barry with Investor Loan Source. So we're back for the third edition of my little series that I've put together with some kind of a question and answer type thing to give people information about the market and what we see in the marketplace right now as we are now midway through May and kind of in the reopening process after this COVID-19 shutdown. So today I want to talk about the performing note market and why I think that market is a good solid place to invest in at any time in the marketplace. You know, in my last series I talked about not wanting to buy real estate when the prices are at a high and certainly not wanting to sell when they're at a low. But if you're in a short-term or even long-term performing note market, it makes a lot of sense in any market. So we've used that at Investor Loan Source as kind of a placeholder for money until real estate prices fall to a level we think is good to jump back in and start buying physical assets again. So let's take a look at performing notes and why I think they're a good asset class for all market cycles. Number one, in the performing note market, there are multiples of asset classes. You could look at fix and flip notes as one asset class in the note space. You would look at rental loans as the next one, commercial loans as another one. You could even look at homestead loans or consumer loans as yet another asset class in that line. Each one of them has pros and cons, and each one of them can be used at different times as a hedge to whatever's going on in the marketplace. For example, if you were in a time where you thought that interest rates were going to rise through the roof and you were worried about that, you could use your short-term fix and flip notes, right? Because those are 6-month to 12-month notes typically, and at the end, when that thing pays back off, if interest rates have gone up, you just charge more for the money to the next borrower. And of course, the market is high enough across the board that you would be able to do that. So that's how you would use a fix and flip type note in your portfolio if you were worried about rising interest rates. Another way to hedge against rising interest rates on, say, a long-term loan would be to do rental loans. And in a rental loan, you might add an adjustable rate to that mortgage. So maybe I'm doing a 20-year loan or a 30-year loan, but I'm able to adjust that interest every time interest rates adjust. That, again, is a hedge to interest rates rising. So those are some of the strategies that we've used to be able to hedge against rising interest rates. Now, we're not in currently a rising interest rate environment, but those are still things that we have thought out, and they are, let's say, safety valves that we have placed in our loans or in our portfolio so that if those things do occur, we're still safe and our investors are still safe. So another reason that I like performing notes is that you can get great diversity. I've talked about the diversification of the different note classes, but you can also diversify in a lot of other ways as well. You could diversify based on price of collateral. In other words, do I want to have a lot of notes that are on properties that are worth $500,000 to $1 million? My answer today, no. My answer 2 years ago, I wanted all of those I could get. Why? Because real estate prices were rising. When we write a note, we get paid based on the value of that loan. So we wanted as many of those larger loans that we could possibly get. But over the last 6 months, we've actually started changing, and our average loan amount has been falling by design. We don't want a lot of these larger home loans right now. I don't necessarily want to have $500,000 rehabs, $750,000 rehab loans. So we're not writing those. What I do like, though, is those $100,000 loans that are on a $150,000 house. Those I'll take all of I can get right now, because I believe if there is a deep recession, we know we're in a recession now, but if it's a deep recession, those houses are going to be somewhat insulated from some of the downfall. Okay? If prices of houses do fall, those houses, the under $150,000, under $200,000, those are going to fall the least in percentage because they don't have that far to go. And as you have a recession, people up here are going to fall to this category. People in this category are going to fall to this category. And where are they falling? They're falling right down into the houses that we have notes on. So demand will rise in a recession for cheap or affordable housing. That's where we're writing loans now, and we're writing them by the bucket load. Now, another way that we'll diversify in a private equity fund is geographically. The geography is important because not every city and not every state is going to rise and fall at the same time. So if all of your notes, if you were running a private equity fund, were in the state of Texas and oil price falls to, say, 0 for a day, and then bounces up and hovers in the $15 to $20 range, might your portfolio be at risk? Now, the short answer would be yes, it might. So we don't do that. Texas is our base, and yes, we do a lot of loans in Texas, but it's not the only place we do loans. We do loans in the Midwest, we do loans in the Southeast, and we do loans in the middle Midwest as well. So we've identified 18 states that we believe are great for doing fix and flip and rental and commercial loans. And we want to diversify among all of those areas so that our whole portfolio is not beholden to the economy of any one particular market. Hopefully that makes sense to you and gives you a little bit more of a glimpse into private equity funds and the benefits of investing in private equity funds. Again, this is not a solicitation for any type of investment, but if you would like more information, we'd be happy to get that for you. Thank you, and I'll see you on the next video.